Good day, everyone. Welcome to Case Analysis 101, where you will gain insights into the fascinating world of pension accounting and employee benefits. I am Maria Grace Tikizo, and with me are Irene, Hannah, Khalid, and Jebril. Today, we will be discussing our case analysis on AT&T's financial reports, focusing on the challenges and solutions in managing the funding status of their pension plans and post-retirement plans. But before that, let us first understand what pension accounting and employee benefits are. So there are two standards governing employee benefits. We have IAS 19 for employee benefits and IAS 26 for the accounting and reporting of retirement benefit plans. So these two standards will be governing our entire case analysis, including some generally accepted accounting principles. So what is pension accounting? Pension accounting is defined as the process of recording, measuring, and reporting the costs and obligations associated with pension plans provided by employers to their employees. It encompasses defined benefit plans where the employer guarantees a specific retirement benefit amount, and defined contribution plans where the contributions are specified, but the retirement benefits depends on investment performance. On the other hand, employee benefits accounting, it covers a broader range of benefits beyond pensions, including post-retirement healthcare, life insurance, and other non-pension benefits. These benefits represents a significant financial commitment for companies, and it needs to be accurately accounted for to ensure transparency and compliance with regulatory standards. Understanding it is vital because these obligations have a substantial impact on companies' financial health and stability. Accurate accounting and reporting ensure that financial statements reflect the true cost and liability associated with these benefits. Now let us delve into the our main case analysis of AT&T's financial reports. So starting with AT&T Incorporation, it is based in Dallas, Texas. It is a global telecommunications company and it is a key component of the Dow Jones Industrial Average. No, the company has faced challenges in managing the fund status of its pension and post-retirement benefits. And in this analysis, we examine and delve into the specific factors driving changes in AT&T's benefit plans, examining impacts of market performance and actuarial assumptions on the overall funding status. Now, there are several concerns we have identified during our analysis. First is the underfunding of both the pension and post-retirement benefit plans. Underfunding poses a significant risk because it may potentially impact the financial stability and required require increased future contributions. Second, we have the reliance on expected return on planned assets. Though under US GAAP, the use of expected return on planned assets is allowed, but it may not accurately reflect actual performance. It can lead to an overstatement of income and an understatement of liabilities. Further, we also identified significant impact on the financial crisis on val- plan asset values highlights the vulnerability of funding status to the market volatility. Now, while diversification aims to mitigate risk, the analysis suggests that the investment strategy may require review and adjustment to ensure it can withstand various economic scenarios and maintain adequate funding levels. During our analysis, we also find that though there are diversification in the investment of plan assets, there may be some uh, long-term impacts as we have find out that their plan assets actually provides losses on the overall fair value. Now, by adhering to relevant accounting standards, including US GAAP, IAS 19, and also IAS 26, accounting and reporting by retirement benefit plans. This study aims to provide a comprehensive understanding of the challenges and solutions in pension and employee benefits accounting, ensuring accurate financial reporting and effective management of future obligations.
AT&T provides a comprehensive range of pension and post-retirement benefits for its employees, covering both management and non-management personnel. These benefits include non-contributory pension and death benefit plans, traditional pension plans, and cash balance plans with options for lump sum or annuities upon retirement. As described in IAS 19 Employee Benefits, a defined benefit plan is any retirement plan that is not a defined contribution plan. It is a plan where an is amount a defined amount is provided, usually as a function of one or more factors such as age and years of service. Mergers have integrated various pension plans from ATTC, BellSouth, AT&T Mobility, and Ameritech Publishing Ventures into the AT&T Pension Benefit Plan. Additionally, medical, dental, and life insurance benefits are provided to retired employees, with costs accrued as these benefits are earned. The company's plan assets, which include private and public equity, government and corporate bonds, and real estate, are maintained to meet ERISA requirements and managed to maximize long-term returns while minimizing risk. Further, AT&T uses Voluntary Employees Beneficiary Association or VEBA trusts to help fund the costs of pension and post-retirement benefits like medical, dental, and life insurance for their retired employees. However, there are no specific legal requirements under the Employee Retirement Income Security Act or ERISA or any other regulations that mandate these post-retirement benefit plans to receive new funding every year. Essentially, while AT&T chooses to allocate funds into these VEBA trusts to support the benefits, they are not legally obligated to do so on an annual basis. This gives the company some flexibility in how and when it funds these post-retirement benefits. The primary investment objectives for these assets are to ensure that sufficient funds are available to pay out pension and post-retirement benefits as they become due, regardless of future economic conditions. AT&T aims to maximize long-term investment returns while maintaining an acceptable level of risk tailored to their pension and post-retirement obligations. To achieve this, the company ensures broad diversification across various capital markets to protect against adverse experiences in any single market. Moreover, IAS 26, Accounting and Reporting by Retirement Benefit Plans, governs the accounting and reporting for these plans, including necessary disclosures. This standard ensures that the financial statements of AT&T provide a true and fair view of the plan assets, liabilities, and financial activities, promoting transparency and accountability in reporting. Under IAS 26, all plans should include in the reports a statement of changes in net assets available for benefits, a summary of significant accounting policies, and a description of the plan and the effect of any changes in the plan during the period. These are the significant assumptions used by AT&T in evaluating their FBPA, PBO, and net benefit costs. For defined benefit pension plans, the benefit obligation is the projected benefit obligation, VBO, the actuarial present value as of our December 31 measurement date of all benefits attributed by the pension benefit formula to employee service rendered to that date. The amount of benefit to be paid depends on a number of future events incorporated into the pension benefit formula, including estimates of average life of employees or survivors and average years of service rendered. It is measured based on assumptions concerning future interest rates and future employee compensation levels.
Hi, I'm Triple Stencil, and in this part, we will talk about the funding status of AT&T's pension plan. But before we delve into that problem, let us first know the key metrics for evaluating the funding status. The fair value of planned asset as defined by IAS 26 reflects the current market value of the investment, held within the pension plan. The value provides a snapshot of the financial resources available to meet future benefit payments. On the other hand, the projected benefit obligation represents the present value of expected future payments to retirees based on current service or compensation levels. This metric, guided by IAS 19 employee benefits, estimates the total liability of the plan, projecting the benefits owed to employees as they retire. So by comparing the fair value of planned asset to post-employment benefit obligation, we will get our funding status. So let us refer to the table to get to know the amounts we are dealing with when it comes to our projected benefit obligation. For the year 2007 to 2008, our PBO beginning will be adjusted with the following amounts from service cost, interest cost on PBO, amendments, actuarial loss or gain, specific termination benefits, any settlements, benefits paid, and others to get our final amount of PBO at the end of the year. So let us again refer to the table to get to know the amounts we are dealing with when it comes to fair value of planned asset. So for the year of 2007 to 2008, FVPA beginning will be adjusted from the following amounts of actual return on planned assets, benefit pays, contributions, others to get our FVPA begin, our ending. So let's take some time to process the amounts from the table. Okay, so as you can see, AT&T's pension plan have experienced significant changes in their funding status over the years. So as of 2008, the pension plan was underfunded by 3,994 million, which is a sharp decline from being overfunded by 17,288 million in 2007. This dramatic shift was mainly driven by substantial negative returns on planned assets, with the fair value of planned asset from 70,810 million in 2007 to a dramatic decrease of 46,828 million in 2008, largely due to poor market performance. Conversely, the projected benefit obligation for the pension plan decreased from 53,522 million to 50,822 million, influenced by factors such as actuarial gains and benefit payments. So to fully understand this part, we need to know the factors that affect changes in plans and assets. So first we have our market performance. Fluctuations in the performance of equity, bonds, and real estate markets affecting the value of planned assets. The investment strategy, contributions to benefit payments, payments made to retirees, reducing the total assets in the plan. Economic conditions also we need to consider, and actuarial gains or losses, which is the changes in demographic and financial assumptions, like for example life expectancy, employee turnover, and early retirement, which can lead to actuarial gains or losses impacting liabilities.
The balance sheet presentation of defined benefit plans involves two factors: recognition of the plan's funded status and classification of the funded status as current or non-current. The funded status is the difference between fair value of plan assets and the benefit obligation. The benefit obligation refers to the PBO for pension plans and the accumulated post-retirement benefit obligation for OPEB plans. In AT&T's consolidated balance sheet, the amounts related to the pension plan are the post-employment benefit under asset portion with balances of $0 and $17,291,000,000 as of December 31, 2008 and 2007, respectively, and the post-employment benefit obligation under long-term liability with balances of $31,930,000,000 and $24,011,000,000, respectively. The current portion of employee benefit obligation in this table is included in the accrued accounts payable and accrued liabilities in the consolidated balance sheet, while the employee benefit obligation is included in the post-employment benefit obligation.
Now we are still on the evaluation part of this presentation. We are currently in guide question number 3. So for this guide question, we have 4 questions to answer. First question is the pension expense for AT&T's fiscal year 2008. And second question is how much relates to an increase in the benefits ultimately payable that is attributable to an additional year's employment. Third question, what is the largest component of the pension expense? And lastly, how has this component evolved over time and what is driving this evolution? So for the first question, we have this simple table right here, the total pension expense for AT&T's fiscal year 2008. So as you can see, we are down to an amount of a negative $967 million dollars. So all of this amount reflected in here is in million dollars. For simplicity, we are eliminating the zeros. So for these components, these are part of the pension expense in computing the pension expense. So we have current service cost amounting to $1,173 for interest cost on PBO, the expected return on planned assets, amortization of prior service cost and transition asset, recognition of actuarial loss until to the amount of net pension benefit. Since we totaled a negative amount, we now have a net pension benefit for AT&T's fiscal year 2008. Next, for the second question, what is how much of the amount relates to an increase in the benefit payable attributable to an additional compensation period? Meaning, these are the costs incurred by AT&T when they prolong their compensation period. So what are these costs? These costs are current service costs with an amount of 1,173 and interest cost on PPO with an amount of 3,319, both in million dollars. So again, that is for question number 2, attributable to an additional compensation period. We have the current service cost and the interest cost on PBO. So next is the third and the fourth question, which is the largest component of the pension expense, and how has this component evolved over time, and what drives this evolution. So obviously, as we look at this simple table here, the largest amount is the expected return on plan asset, which is $5,602 in million. But if that component, if this expected return is not substantial, then we consider interest cost on PBO as the largest component of the pension expense. And this is due to the increase in the overall pension obligation due to passage of time and the determination of appropriate discount rate. So over the years, 2006 to 2008, the discount rate of AT&T for the determination of PBO had been increased by 0.5%, resulting in a decrease both in pension and post-retirement benefit obligation, thereby improving the funded status of the pension plan. So this is what happens when you increase the discount rate. Your benefit payable will also decrease, thereby improving the funded status of the pension plan.
Moving on, I am going to discuss the key assumptions in AT&T's pension calculations. So our analysis begins with three critical assumptions used by AT&T: the discount rate, the expected return on plan assets, and the salary increase rate. First, the discount rate determines the present value of future obligations. Between 2006 and 2008, AT&T strategically increased this rate by 0.50%, reducing the projected benefit obligation and improving the plan's funded status temporarily. Second, the expected return on plan assets. For 2008, AT&T estimated $5.6 billion in returns, but the actual return was a significant loss of $18.2 billion due to the financial crisis. This divergence increased the underfunded status significantly, from $6.1 billion in 2007 to $31.4 billion in 2008. Lastly, the salary increase rate reflects employee compensation trends and impacts future benefit obligations. Now, let's talk about the impact on AT&T's balance sheet. The higher discount rate lowered the projected benefit obligation, giving temporary relief to the funding status. However, the severe underperformance of plan assets compared to expectations worsened the pension liability and added stress to the financials. These factors taken together highlight the importance of adjustments in strategy and contributions to stabilize funding. Moving on to the reasonableness of assumptions. Individually, yes, they follow standard practices and align with AT&T's strategic financial planning. However, the 2008 results reveal the risks of overly optimistic return expectations, especially in volatile economic environments. Going forward, more conservative assumptions could improve financial predictability and reduce funding risks.
Moving on, we have here, given your answers above, how do you think pension expense in fiscal year 2009 will compare to pension expense in fiscal year 2008? Make a reasonable estimate. So our overall expected pension expense for 2009 will be $501 million. So there is a significant increase from our net pension benefit in 2008 of $967 million. So how do we compute for these estimate? Now there are several factors we consider, starting off with our service cost. So when computing for our service cost, we consider the 1 point percentage change provided in AT&T's notes to financial statements. So it stated that any 1 point decrease in our expected future medical and healthcare expenses will also result to a decrease by an amount of 315 on its service cost. Provided these, we then average the total number of retirees below 64 and above 65 to get an estimated number of retirees. We then compare the rates during 2008 and 2009 rather, which yields us with a difference of about 0.7%. We then compute for the estimated decrease in our service cost by multiplying 0.7% with 315 decrease to get an estimated decrease of 244 in the service cost for 2009. So provided our previous service cost for 2008, 1,173, we deduct 244, which results to 929 service costs for 2009. Now, for our interest cost on PBO, so the discount rate used in computing the interest cost in PBO from 2006 to 2008 has consistently increased by 0.50%. So from 6% in 2006 to 7% in 2008. So in computing for our interest cost for 2009, we assume that this increase will remain constant. So we have 50,822, that's our beginning projected benefit obligation. So times 7.50%, 5822 times 7.50%, we have 3,811. But then we have to deduct 10%, is which will be capitalized as part of the construction labor, providing a small reduction in the net expense recorded. So that's 3,811 multiplied by 90%. So we have an estimated interest cost of 3,430. So next, we have our expected return on plan assets. So we have a constant rate for expected return. That's 8.50%. So we get our beginning FBPA, that's 46,828 times 8.50%. So that's 3,980. So in setting long-term assumed rate, the management considers capital markets future expectation and asset mix of the plans. And then we have amortization of prior service costs. So this one, it's provided in our notes to financial statement. Stated there is an amortization of service costs by an amount of $111 million. And then lastly, we have our recognized actuarial loss. So for the actuarial loss, so we consider that any increase in the discount rate will also affect our PBO, that's our projected benefit obligation, which then we assume that our previous loss will also increase by 0.50%, which result to a recognized actuarial loss of 11. So that's 929 plus 3,430 less 3,980 plus 111 plus 11. So that's a total of $501 million of net pension costs, estimated net pension costs for 2009. So now we have letter B. Estimate operating income for AT&T in fiscal year 2008 as if AT&T had elected to immediately recognize actuarial gains and losses in its operating results. That is, as if pension expense was determined by actual returns instead of expected returns. So here's our prior adjustment net pension expense. We have calculated this using the expected long-term rate of return on plan assets, which approach is actually allowed under US GAAP. However, using the actual return on plan assets would provide a more accurate picture of our financial performance. This is because when we use the expected rate, it tends to smooth out the volatility in the investment returns. So it may potentially lead to an overstatement of income during periods when actual returns are actually lower than expected. So as was the case during the financial crisis 2008. So on the other hand, actual returns reflect the real performance of our investments, offering a transparent and realistic view of our financial health. So on to the next slide, we have adjustments. So pension expense was determined by actual returns instead of expected returns. So when we use the actual return, as you can see, our pension expense actually increased from a net pension cost of 960 net pension benefit of 967 to a net pension cost of 22,825. There is a big difference. This is because our actual return on plan asset indicates loss. So that's a loss of 18,190, increasing our overall net pension cost. So where can we find our actual return on plan assets? So this is easy. The actual return on plan assets can actually be traced on the fair value of plan asset valuation during the year 2008. As per notes to financial statement, here's our fair value of asset valuation. So we have the beginning FBPA, that's 70,810. And then we have the actual return on plan assets. So normally, actual return on plan assets are added to the beginning value of the FBPA. However, in this case, there's a loss on our return on plan assets, so we have to deduct it. That's 18,190 to be deducted, and then of course our benefits paid to be deducted. And then there's actually no contribution during the year. This is because AT&T uses the VEBA Trust Fund, which requires no contributions. The ERESA requirements does not provide annual contributions to FPPA. And then we have others, 3. So that's a total of FPPA and 46,828. And then we have here calculation of the consolidated income statement. So based from our consolidated income statement report, so this is in million dollars, we have the income before tax for 2008, we have 19,903. So we have to deduct, of course, our net pension benefit. So since this is a benefit, we have to deduct it because it increases our income. So that's 18,936. And then we have to deduct also our net pension cost to be recognized using the actual return. So that's minus 22,825. So we have an adjusted loss before income tax. So that's a loss of 3,889. So, as you can see, um, using actual return better, it reflects the realistic view of our financial health. So this transparency is actually crucial for making informed decisions about contributions and funding strategies to ensure the sustainability of our pension and post-retirement benefit plans. So by transitioning to actual returns, we would align more closely with the economic conditions and provide stakeholders with a clear understanding of our financial obligation and asset performance. This change would enhance the accuracy of our financial reporting, promote better risk management, and ultimately support the long term financial stability of our benefit plans.
And now we arrive to the solutions and recommendations. So, first thing is that AT&T shall uh, be able to adjust the long-term rate of return. So, this rate of return is used in computing their expected return of in-plan assets. So as IAS 19 employee benefits provide, they require entities to use a discount rate that reflects the time value of money and risk specific to the liability. This rate is used to discount post-employment benefit obligations and should be based on market yields on high-quality corporate bonds. So what happened in AT&T's fiscal year 2008 was that there happened a big gap between the expected return and the actual return in planned assets. So the expected return amounted approximately $5,000 in million dollars, while the actual return was in a loss. It was around 18,000 in million dollars. So it was a loss compared to the expected return. It was um, a gain, but it was very different. There was a really big gap between the two components. So because of that, AT&T should be required to review or adjust, or it may be necessary to review the long-term rate of return. So, so next one is the review benchmark per portfolio and asset allocation policy. So IAS 26, or the Accounting and Reporting by Retirement Benefit Plans, provides that the disclosure of plan assets, including the allocation and performance of these assets, because this ensures transparency in how the plan assets are managed and the risk associated with the investment. So in their notes, AT&T's notes, they provided information about their asset allocation policy only to the extent what of where these policies are based. So they provided that their asset allocation policy are based on a study conducted in 2007 and 2008. And they also provided a table containing their equities, which is consisting of almost half of their plan assets. So they are dealing with a lot of equities in their plan assets. So aside from that, other than that, they provided nothing about their asset allocation policy, which they might be required, or it may be necessary to provide further information about the asset allocation policy for transparency purposes and also in compliance with the standards of the IS 26. Another thing is to review the benchmark per portfolio, since they have a lot of equities in their plan assets. It is very vital to understand how these securities are performing in their own markets. They could also consider benchmarks to better cater each type of securities for their designated market. Although it is easy to compare an aggregated account of a portfolio to a single benchmark, it could be helpful for AT&T to review each benchmark that is assigned to a portfolio for a better understanding of their securities in their designated market.
Given that the plan's liabilities exceeds asset leading to an underfunded status, the company should come up with strategies to enhance its funds such as increasing its annual contributions to the pension plan. Although AT&T is not legally obligated to fund its post-retirement benefit plans annually, it should consider establishing a more consistent funding strategy to improve the funding status of its pension and post-retirement plans. This could involve setting aside a percentage of profits each year to bolster the FIBA trust. According to Financial Accounting Standard Board's ASC 715, accounting for defined benefit pension plan, companies must recognize the funded status of a pension plan in their financial statements, which means improving the funded status can enhance AT&T's balance sheet and reduce pension-related expenses. Moreover, regularly review the assumptions like discount rates and expected return used in calculating the projected benefit obligation and pension expenses. Given the significant losses in actual returns compared to expected returns, a more conservative approach to estimating future returns may be warranted. This could involve adjusting the expected return on planned assets to align more closely with historical performance and current market conditions. Again, with the same standard, it requires that companies to use assumptions that reflect current market conditions. Regularly updating these assumptions ensures that the financial statements accurately reflect the plan's obligations.
Now, to conclude, here are some important notes and highlight takeaways. AT&T's pension plans faced significant underfunding in 2008, driven by market downturns and overly optimistic assumptions about returns. This highlighted the importance of realistic financial planning and careful investment strategies. Our analysis emphasized the need for revising return assumptions, regularly reviewing portfolios, and aligning discount rates with economic conditions to address these challenges. These steps are essential for ensuring the long term sustainability of retirement benefits and maintaining financial transparency. Overall, this case underlines the value of prudent management and adherence to accounting standards in securing employee benefits. So that would be all for our presentation of this case study. I hope that you have learned something about this and thank you for watching. And we would like to thank Mom Berlin for such a fruitful semester and we hope to see you again next semester. Thank you, Mom.